In this week's video, we'll review the latest charts to help us determine if the facts in hand favor a correction that will eventually be followed by higher highs or a long-term bear market. We'll kick off the video with a daily chart of stocks versus bonds. This chart is dated December 3rd, 2007, which is 55 calendar days after the S&P 500 peaked in October of 2007. There's a reason we chose 55 days. In the present day, on Thursday of this week, that was 55 calendar days since the S&P 500 peaked on January 26th. And some of the charts we look at were created on Friday, March 23rd, which is 56 days after the S&P 500 peaked. During long-term bear markets and recessions, for the most part, common sense tells us that investors will migrate away from growth-oriented stocks, especially on a relative basis, and towards defensive-oriented bonds, which is exactly what happens on this chart here. In this case, we're using the 100, 105, 110, 115, and 120 simple daily moving averages for illustrative purposes only to illustrate concepts. The net aggregate opinion on the left side of the chart is bullish. And we get over here, it's bearish. And in between, it's indecisive. We know we basically have three market types: bullish trends, consolidation or indecisiveness, and bearish trends. We have all three on this 1, 2, 3, 4, 5 month chart. So using just this handful of moving averages, soon after the stock market peaked, we had a full bore bearish look in this ratio, telling us that this period here looks quite a bit different than this period here or anything back here. And if we draw a horizontal line going backwards from the cluster here, or the blue moving average, the 100-day, we can go all the way back to this point here, roughly 3 months back, and still hit the same moving average. And that's a measurable sign of indecisiveness and higher risk. And eventually we flip over to that full bore bearish look over here. How does the exact same ratio, risk on versus risk off, look 55 days after the stock market peaked in 2018? The answer is quite a bit better, and the present day really doesn't look anything like this concerning rollover look here. This point here, 55 days after the peak, doesn't look anything like this. This is a full bore bearish look. This is a full bore bullish look, with blue the fastest moving average on top, and the slopes of all of the moving averages are positive. And if we try to draw a line backwards from the 100-day moving average, we really can't do that. We'll never hit a moving average here. We don't even have a sign of a consolidation period here. And typically, what happens during a recession? What does the Fed do? Do they raise interest rates, or do they have a tendency to err on the side of lowering them? They lower interest rates, and that has a tendency to be good for bonds. And historically, stocks don't perform very well at the early stages and during a recession. Therefore, the look of this chart is exactly what we would expect before really bad things happen. We don't really see, using these moving averages, an appreciable difference in the risk tolerance here or even here. Let's look at some other time frames, some of them faster and some of them slower, and see what we can learn. Similar situation here. If we go out to a weekly chart, our 30, 40, and 50-week generic moving averages for illustrative purposes only, similar concept here. If we draw a line going backwards from the simple 30-week moving average in blue, we can hit that same moving average 4.5 months earlier from point A to point B. A sign of indecisiveness and consolidation. This is what it looks like when we roll over from a long-term bullish trend to a bearish trend eventually. In this case, how does the exact same chart look today, 55 days after the peak? This is 55 days after the top. This is 55 days after the top. If we try to draw the orange line going backwards here, we're never going to come anywhere close to the 30-week moving average. This is a much stronger, higher conviction look than this period here. And by the time we get to 55 days after the peak, we have evidence where all three of the moving averages at some point had rolled over. 55 days after the peak here, we don't have anything like that. These aren't close to rolling over. This is much, much stronger than this. And at this point, you may say, well, those are very long-term moving averages. What happens if you look at shorter-term or intermediate-term moving averages? 55 days after the market peak, the ratio of stocks, SPY, to bonds, TLT, or risk on to risk off, looked ugly over here. And in this case, we're using this simple and for illustrative purposes only generic 60 days, 65 days, 70, 75, and 80 simple daily moving averages. If you've been watching these videos for a long period of time, we know when we get a tight moving average cluster that we have a tendency to get big moves after that. And that's exactly what happened from this point here. We had a big move in this direction. And the bias for the big move would be down in this case even before it happens, because look at the slope of the moving averages. If we had a tight cluster like this and it was flat, then we really couldn't assess the odds. But here we can assess the odds by just looking at this. If we go down to faster moving averages, how does the exact same chart look 55 days after the peak in 2018? The answer is infinitely better. We still have a full-bore bullish look. And instead of having a tight moving average cluster on the screen that favors longer-term bearish outcomes, we just had a tight upward sloping moving average cluster here that helped foreshadow this move here. If we're going to go into a multiple year bear market and or a recession, it's highly unlikely that the 60-day moving average in the ratio of SPY to TLT is going to continue to look like this. Which means if really bad things are going to happen for a long period of time, which is always a possibility, then this type of chart's not going to miss it. Eventually, this will roll over and start to look like this. And right now, it doesn't really even have a serious rollover look yet. In this chart, this version is Friday, March 23rd at 11 a.m. So we're looking at two things on these charts, the trends and asset class behavior. We're learning a lot because this is the conviction to own growth-oriented stocks relative to the conviction to own defensive-oriented U.S. Treasury bonds backed by the full faith and credit of the U.S. government. If we pictured in our mind's eye what the ratio of consumer discretionary stocks relative to consumer staples would look like as the stock market peaked in 2007, this is exactly what we would expect. The trend flattens out and rolls over against growth-oriented cyclical stocks relative to more defensive-oriented consumer staples. Now notice, this ratio here is waving yellow flags telling us that the conviction to own defensive-oriented consumer staples already flipped over relative to the conviction to own consumer discretionary stocks before, well before, the S&P 500 peaks over here in October of 2007. This is our tight, indecisive look where we would want to wait and then it breaks to the downside. And 55 days after the S&P 500 peaked, we have a full-bore bearish look favoring the defensive ETF over the growth-oriented ETF. How does the exact same ratio look today, 55 days after the peak in 2018? Does it have a concerning look like this that might be forecasting a move in this direction? The answer is absolutely, positively no. And remember, we're looking at facts here. These are hard data fact charts. This is an indisputable mathematical moving average. And if we put price on these charts, it would not change our interpretation of what we're looking at in any shape, form, or fashion. Instead of having the red flag, pay attention, or yellow flag in here, a big move is coming. We had that here, but the bias was up because the slope was up and then the break was to the upside. These charts are almost binary opposites. Concerning look in the upper left, price moves from the upper left to the lower right. That's a bearish trend. In the present day, concerning look in the lower left, and price moves from the lower left to the upper right. And in both cases, we're 55 days after the market peaked. Every single chart that we've looked at so far tells us the odds favor a correction in the present day over a long-term, multiple month or multiple year bear market. And that's a probabilistic statement. Anything can happen. And if we're going to go into a multiple year bear market, which absolutely positively could happen from here, especially with new information about tariffs and a trade war on the horizon. These things have just surfaced in the past few weeks. But even if that's the case, this chart and all the charts we've looked at going backwards so far, and the ones that we'll look at going forward, it won't continue to look like this. Eventually, this is going to morph into something like this, and then this. If that happens, it will be reflected in the data and reflected in the model, and eventually reflected in our allocations. There's nothing concerning on this chart as of Thursday, March 22nd. And the look of these moving averages didn't appreciably change in one session. All these charts are painting a similar picture. We have bullish trends, consolidation, and rolling over into bearish trends. And we get a second look because we're looking at relative performance of a growth-oriented asset like semiconductors relative to a defensive-oriented asset like long-term stodgy treasury bonds. This is our risk on. This is our risk off. How does the exact same ratio look 55 days after the peak in the present day? Infinitely better. We have a chart that's moving from the lower left-hand corner to the upper right-hand corner, which is exactly what we want. This is a bullish trend. This is basically how we make money. There's nothing particularly alarming on this chart either. Before we shift gears to our 100 all the way out to the 290-day simple moving average charts, it should be noted we're not making direct comparisons between 1999 and the present day, or the year 2000 and the present day, or 2007 and the present day. We're making a comparison between concepts. What does it look like when you flip over from a high conviction look to an indecisive look to a low conviction look? You can see on these two charts here, the fundamental issues of the day and valuations are quite a bit different on the left side of the screen than the fundamentals and valuations on the right side of the screen. And yet, the trends rolling over look very, very similar. This point in here looks very, very similar to this point in here. In both cases, blue, the fastest moving, averages on top. Blue, the fastest moving average is on top, and eventually blue, the fastest moving average is on the bottom, and blue, the fastest moving average is on the bottom. In the present day, we really don't care if 2018 is quote unquote like 2007 or like 1999 or like 1955 or like 2011. This is how markets work. This is what bullish conviction looks like. This is what bearish conviction looks like. That's what we care about. And these periods that tend to be extreme flips and long-term flips give us an excellent point of comparison. Because just like we roll over here and we roll over here, in the present day, if the stock market is going to go into a 3-year bear market and fall 30 to 50%, it's not physically possible for the chart to look like this further down the road. Eventually, as the market falls, the moving averages will roll over and will move into a full bore bearish look. If it doesn't happen, then the market can't be falling very far. So does the present day look like this or this after a brutal week in the stock market? A week ago, Friday, March 16th, this is what the exact same moving averages looked like. This doesn't look anything, not even remotely close to this. If we fast forward a week to the close on Friday, March 23rd, after the S&P dropped 55 brutal points, this doesn't look anything like this period here. And this doesn't look anything like this period here. And yes, it's possible that this morphs into a look like this, and that's where the flexible, unbiased, and open mind comes in. If we need to take action when the math starts to roll over in a material manner, we will take action. As we've shown many times in past videos, this look here looks like high conviction and a trend that eventually goes on to make higher highs. Will that happen in the present day? That's to be determined. We take it day by day. We're simply talking about the probability of good things happening relative to the probability of bad things happening. Said another way, this also helps us with the probability of higher highs being made into the future relative to a series of lower lows being made. Thus far, all of the charts that we've reviewed tell us the present day really doesn't look at this point like the early stages of a trend that's rolling over into a long-term bear market. Therefore, how does the present day compare to, let's say, a very, very deep correction within the context of an ongoing uptrend? If you look at the S&P 500 chart in 1998, from the intraday high here to the intraday low here, the market fell 22%. It did not fall that far on a closing basis. On a high to low basis, this is actually a bear market, which tells us how silly the arbitrary definition of a bear market is. What we're concerned about is a multiple year or multiple month bear market that would be very, very difficult to recoup the losses. This type of environment is not particularly concerning. Why? Because eventually good things happen here, which is not the case here. It's going to take a long, long time to recoup the losses that take place on the right side of this chart. Notice in 1998, the market made a lower low relative to this low intraday, telling us to remain open to a lower low in the present day, even under a bullish scenario. So why in our mind do we really not consider this to be a bear market, and why wouldn't we treat it that way? Well, number one, the duration is relatively short. We peak in July. 1 month, 2 months. It's about 2.5 months. That's not a long time to wait. And number two, the 22% loss, a very, very nice gain was tacked on top of that. The move from this point A here, this lower low here, to the peak here in the year 2000, this is a 68% gain, telling us that the patience, or whatever patience we could have exercised within the context of the model and the math, was greatly rewarded going forward from this point A here. For example, if you had $1 million here and you panicked and sold out, you would have missed a move in your account from 1 million to 1.6 million at point B. So how does the present day compare to 1998? Because we know this is a big drop here. 56 calendar days after the peak in 1998, this is what the 75, 80, 85, and 90 generic, and for illustrative purposes only, simple daily moving averages look like. We know this is a full bore bullish look. This is a very, very concerning look that we just went over. It's a tight cluster with a downward slope telling us bad things could happen. How do the exact same simple moving averages look 56 days after the peak in the present day? The answer is quite a bit better, telling us that the market's profile prior to the peak in the present day was stronger than the market's profile prior to the peak in 1998. Said another way, bullish conviction in the present day relative to bearish conviction was stronger when the market peaked in 2018 than it was here before this intermediate term peak in 1998. So the present day looks better than this period here. And if we were patient in this period here, we were rewarded in a big way with a move of 68% off of that low. And all of this, like anything else we look at, speaks to the probability of good things happening relative to the probability of bad things happening. So as noted on short takes a couple of days ago, this is the present day look of the S&P 500. This is Friday, March 23rd. The intraday low in February of this year was 2532. If we have something similar to what happens often, not just in 1998, would not be unusual even under bullish circumstances to have the market undercut this low here for a very short period of time, somewhat of a failed breakdown. So we break below this low here, it triggers all kinds of stop loss orders and a semi-panic. We fall further down here, and then the buying could start. Therefore, if we break below 2532 for a few minutes, a few hours, or even a few days, we really don't know at that point how meaningful it is. But if we break below 2532 for several days, a week, 2 weeks, 3 weeks, and we're making a series of lower lows over here, just from a price and chart pattern perspective, that would be concerning. So the good news is we've got a reference point relatively close by. We closed at 2588. It's only about 50 points below. We've got a reference point that will help us with bullish probabilities and bearish probabilities. So we should learn something either way in this area here, or if we bottom above 2532 and move in this direction, we would learn something as well. Do we have any changes to the bigger picture at this point? This is the NASDAQ. This is the long-term breakout as of Friday, March 23rd, 2018. We're not even close to giving up this breakout here. And as we've covered in the past, this breakout is similar to this breakout here. After this, stocks went up for a long period of time. The only difference is this is a much more meaningful breakout because this consolidation box lasts much longer than this consolidation box here. And notice, after the breakout between point A and point B here, there are plenty of times where there is significant give back in technology stocks. Normal counter trend moves within the context of an ongoing bullish trend. Price is above an upward sloping blue 50-month moving average. Price is above an upward sloping blue 50-month moving average. And there are times where price comes back down towards that 50-month moving average. And that absolutely positively will happen in the future, even under very, very bullish circumstances in the years ahead. And between point A and point B, there are numerous periods in here where tech leads, and there are numerous periods where tech lags for a time. And there are going to be periods here, even under bullish circumstances, where tech leads, and there are going to be some periods where tech lags. So there's nothing particularly alarming on this chart here either. And we've mentioned in the past U.S. demographics being related to this breakout. Do we have anything else that tells us we could get a move in this direction that would greatly exceed expectations, just as this move after this breakout greatly exceeded expectations in the 1990s? The answer is yes. These quotes are from calendar year 2018 from the CEO of McKinsey & Company, arguably the most respected business consultants on the planet. We are in a period of phenomenal change, about 1,000 times bigger than the Industrial Revolution. Now think about the gravity of that quote. And this isn't an off-the-cuff remark. This is a serious remark that he made in a presentation. Does this quote align with this chart from a long-term perspective? The answer is yes. They align perfectly. He also said, we're in chapter 1 of a 100-chapter technology book. Does this quote here align with this chart here? It does. He went on to say there are going to be 2.4 billion, that's billion with a B, new middle-class consumers coming into the world in the next 15 years. Does this chart here, the longer we go sideways, the bigger the move we can expect to get, align with this quote and this data here? The answer is absolutely, positively yes, from a long-term perspective. And all of the hard data that we have in hand, including the anecdotal examples that we've covered in this video and asset class behavior, say that the present day looks more like a normal correction within the context of an ongoing uptrend, which implies that eventually a higher high will be made above this high here. And if we get some type of dislocation in this direction, when you get a dislocation out of a strong mathematical profile, it tends to be relatively sharp and short-lived, and it tends to be retraced in this direction in relatively short order. But we'll take it day by day, and we're open to all outcomes, including a break in this direction and then a clear downtrend in this direction. We're not forecasting in these videos. We're making probabilistic statements based on facts. And if we're going to go into a long-term bear market, eventually, when we ask this question, based on the facts in hand, are we allocated properly? Number one, we ran the model during the day on Friday, March 23rd, and after the close. The answer to this question is yes. Therefore, we did not make any significant changes to our portfolios. If we're going to move in this direction, eventually the answer will be no, and we will make an allocation adjustment as needed. It's extremely important for us to repeat that process with that flexible, unbiased, and open mind. Our process has nothing to do with forecasting. We're assessing probabilities. If the probabilities change, then we will adjust our allocations as needed. Let's talk a little bit about volatility. Last week we showed that during a bullish uptrend and during a bearish downtrend, it's not unusual for the ratio of green days to red days to be somewhere in the neighborhood of 50-50. A fair question might be, but what about the magnitude of the down days that we've had in the present day? It's not particularly out of character for a long-term bullish trend in any way. Between point A and point B here, there were 278 trading days that featured a loss of 1% or greater. Similar situation here between point A and point B that featured an 822% gain in the S&P 500. There were 359 trading days with a loss of 1% or greater. We don't learn that much by looking at a red day in isolation. We don't learn that much by looking at the magnitude of the loss of a red day about the market's long-term health. I think all of us would have been very, very pleased to withstand the pain in these 359 days if we were able to book an 822% gain between point A and point B. As noted on Twitter on Friday, discipline implies that there's going to be some periods of difficulty and discomfort. There were numerous periods of difficulty and discomfort between point A and point B here to capture this gain. A lot of red days and a lot of big down days. It's uncomfortable, but it's not particularly unusual. So as we head into next week, if things get a little dicey down in this area here one way or another, the hard data will help us make prudent decisions from a bullish perspective or a bearish perspective. And the hard data can also help us with these common missteps. Watching the market too closely, watching our profit and loss too closely, checking our account balances, focusing on forecasts, watching TV, worrying about what everyone else is doing, worrying about what everyone else is saying, trying to avoid volatility. Think about this statement, trying to avoid volatility. To capture this 822% gain, you had to withstand 1,761 volatile days in the stock market. It's not possible to capture big gains without withstanding volatility. Always being fearful of the next pullback, always being fearful of the next bear market, running through countless what if this could. Basically having a short-term focus and or short-term fear. Based on the hard data that we have in front of us as of March 23rd, 2018, after the close, the base case from a long-term perspective, until proven otherwise, is that good things could still happen for a very long period of time. It may also be worth a visit to the new website to see the FAQs. We've got new and expanded FAQs covering traditional investing, low-cost passive investing, and the online/robo strategies that are currently in vogue. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.